Good afternoon, everybody. I hope you are all well connected and that you can hear me. So I am Stéphane Yvon, member of AMRAE Board of Directors, the French Risk Managers Association, and in the F Risk Management team, I'm responsible of the group captives, which are 500 million euros in assets approximately. I'm also looking after the interests of EDF in the insurance mutuals EDF is a member of. And I'm also in charge, more recently, of the EDF group employee benefits. This workshop will last approximately 1 hour and a half. We will have time for presentation from the speakers and also time to answer your questions. So put your questions as you want to raise them, and we will answer them during the presentation. And we will probably also give a little time at the end of the presentations if there are extra questions. There will also be some polling questions to receive your opinions during the presentation. So, hard market. This has not been seen since 2001 and the terrorist attacks on the World Trade Center. The upturn in the insurance market, which started mid-2019, has been dramatically reinforced by the health crisis and its various impacts on unexpected losses, uncertainty of coverage, assets valuations, and market cap for the insurers. So, insurance market is rapidly changing, leading to shortages of capacity, shrinking coverages, and naturally increase in pricing. Risk managers and their companies, of which most have also been hit by the crisis, have to reconsider their options in a reduced time frame. So this workshop will address the alternatives which exist to the traditional market to manage and transfer your risks. These solutions may be of insurance or financial nature. We will also explore the advantages of the use of captive solutions in this very moving environment. So Karsten Berlag is regional head Americas of alternative risk transfer with Allianz Global Corporate and Specialty. He will give us an overview of the alternative markets and solutions. Matthew Latham is global programs and captive responsible at AXA XL, part of the AXA Group. He will present the rationales and advantages of running a captive. And Bart Smets is risk manager of Umicore, a global player in materials technology. He will tell us his story of the path of the study of creation of a captive in an industrial group. So, Karsten, I will give you the first question. Can you tell us what is available and the novelties on the alternative market?
For the introduction, Stefan, I am very happy to participate in this and spend the next few minutes to talk about what we determine an alternative solution to be, or how we can help in this unprecedented market that you just described. Generally, as part of a large insurance company, we as an alternative risk transfer unit within Allianz Global Corporate and Specialty work very closely with the traditional lines of business, like a property line or liability line. We have various different traditional insurance underwriting departments, and we work very complementary together with them, trying to see if there's a traditional solution available. But as you mentioned, in today's markets, often the traditional way of looking at risk is insufficient to provide a solution to our clients. that are often very sophisticated and have risks that in these dislocated and unprecedented markets cannot be addressed in a traditional form. It goes without saying, as it says here on the slide, that everything that we create new would have to follow regulatory and be compliant with any regulations. I just have on the next slide a few different areas, and you can slice and dice the alternative sector any way you want. But what I have here is basically in the first two columns, I have enterprise risk management or fronting solutions, and then structure or integrated insurance solutions. And the same could go then for reinsurance solutions. The difference is basically that, when you have a client that has a significant risk, to have a full risk transfer solution, like you have in the traditional markets, often, especially in hardening markets, results in a very high price. And, clients are just often not able to afford those prices, and they don't need a full risk transfer to address the risk that they have. So what we are trying to determine in the alternative market is where is the optimal point between the client on one side and the insurer on the other side, in terms of where should the risk lie. And the closer the risk can lie with the client in more of a fronting solution, the less the client pays. So we're trying to determine that point where the client gets the most bang for the buck, if you will. How does that work in the structured insurance in integrated solutions? You could, for example, have second loss triggers. You could have a return premium if the loss experience is very good. Just things, structural elements within the insurance products that align the insurer and the insured in a better way than in the traditional insurance environment. Again, the extreme is that the client retains all the risk, and we are just providing a fronting policy for either administrative ease or just so that they can avail themselves to the services that we provide. But that's sort of and I talk more about these two areas. Then I have a third one here, that's parametric solutions. They can be done in insurance form, but they can also be done in financial product form. And they are often, addressing certain weather risks, climate risks, but the indices that we create, the parametric index products, could also address other, risks in, for example, agriculture or property. And then we have capital solutions, another area that is part of the alternative solutions. And what we essentially do in the capital solutions space is transferring insurance risks into the capital markets. In the 2008-2009 crisis, a lot of institutional investors realized that insurance risks are uncorrelated to financial and credit risks, and there's an attraction to maybe buy a little bit more into their institutional portfolios of uncorrelated risks. So there was a large demand or appetite for those risks that can be cat risks, hurricanes, earthquakes, but it could also be life insurance risks, just risks that the insurance companies naturally produce. From our perspective, somewhat of an alternative to reinsurance, just to manage our portfolios. But if you have a large aggregated risk, again, giving access to capital markets investors that might have appetite, and ultimately it results in whoever bears the initial risk to have the best price for it. Here I put together a few buzzwords that we often hear when we talk to our clients. I mentioned a few of them already in my presentation. We will hear more from Matthew about captives. Often we entertain our transactions or talk to clients to mitigate some cash flow volatility that they have. I mentioned, for example, that we have return premium or additional premium features at the end of the risk period. We carry a AA credit rating, we at Allianz. which is expensive relative to our market that is traditionally more single A. But it comes in very handy in the fronting, for example, but also when we provide solutions to the client that ultimately result in lower cost of capital for them. An example would be if a wind farm developer wants to build a wind farm, and the main operating risk of the wind not blowing can be mitigated with an insurance solution, and the banker who provides the loan to that wind farm realizes that rather than having that often unrated wind farm developer enhancing their credit quality with a AA credit rating on the main operating risk, and the result is much lower cost of capital, and the cost of capital improvements are generally more than what they pay for the insurance, so that becomes a accretive value to the wind farm project. Often we hear that risks are uninsurable, what you see there in the lower part in the middle. What gets us excited on the alternative side is that we have something that maybe the traditional insurance markets are striking out on, that we create a solution that makes an uninsurable risk insurable for a client and really solves something where the client has a burden. I have just below that non-damage business interruption. Those are often risks that clients are concerned about. And again, that we are often solving those non-damage BI issues with a parametric solution that can help a client solve issues when they can't operate their properties because there was a weather event. The weather event could be anywhere in the supply chain, somewhere in Asia, but you can't assemble the computer or something because that part could not be delivered on time because of something adverse happening within the supply chain. Moving on in the interest of time, common features in our alternative solutions. Often we combine various different lines of business. You're going to see that in the next chart a little bit more explained. And we often have our solutions multi-year so that the client has a longer stability in regard to locking in a rate. That is very interesting to clients currently when you have hardening markets and you don't know on an annual renewal cycle whether next year's premium will be again more expensive than this year's and more expensive than last year's premium. And there's more price certainty when you have a multi-year solution that we provide. You also have stability in regard to the aggregate limits of the facility. Just these alternative solutions can provide a client a lot more in regard to being able to budget and project and plan more stability into the future. I promised you a little chart here. We call this integrated solution. So you have
Carsten, excuse me. We have a question from the audience from Sandra. Sandra asks, what is the value of captive and other ART when financial markets are also lackluster? Maybe it's much more for this question is much more for the ART solutions that are related to the financial markets and the capital markets.
I will get to the capital markets on my last slide. If I could just table the question for a couple of minutes and then get
Thank you.
And if I don't sufficiently address it, Matthew will talk more about captives. I don't want to talk too much about that because that's the topic of his presentation, Stefan, if that's okay.
Fine, thank you.
So what you see here, it's maybe a little bit small, but at the bottom you have, on the x-axis, you have different individual lines of business here, like casualty, property, D&O, EPL, workers' comp. And the traditional LOBs have just one slice, one column here, that they insure. And what we do with integrated solutions, I mentioned multi-line. So in the first one here, we have basically a lead integrated policy that cuts across all the different lines of business and combines them. That has a lot more efficiency for a client than doing the individual lines, because you could have a year where you have no losses in one line, and that insurance was somewhat inefficient, but you have maybe a problem in another line, and then the next year it could be the other way around. So this integrated solution is providing some efficiency, and as you can work with the different lines together. The second chart in the middle there is basically a single policy strategy where you have the integrated cover, the excess as well as the lead, across all the different lines. And then in the third chart there, you see more of a high excess solution. Very flexible. Every client gets their own individual solution. These are not, cookie cutter. We're analyzing and modeling with simulations every individual client's needs, and we can combine, various different lines. It's not a set of different lines that we automatically have to include. So, very tailored to the clients. Most of these clients are very large corporations, but they don't have to be. The insurance needs sometimes, are equally, important for smaller clients. In regard to the parametric solutions, a lot of clients claim to have sophisticated risk management, spending millions of dollars on, interest rate hedging, currency hedging, credit default protections. But they don't do anything about their volume risk, which I have here at the top on the chart on the right. And when you go into an analyst meeting, if you're a public company, or if you talk to your lenders or rating agencies that rate your bonds, and you have a business that is sensitive to climate risk, which about 75 to 80% of businesses are, and then you are forced almost by those stakeholders to at least consider the volumetric risk that you have. Let's say you're an airline and you have a lot of canceled flights because of inclement weather delaying or canceling your flights. Or you are a construction company, and because of cold temperatures, you cannot pour the cement, and you have delays on your contracts, and you have to pay penalties, and you have to have more labor costs because people just can't work in inclement weather, high wind on high-rise construction. You could have excess rain in regard to mining operations, transportation. I could go on and mention different sectors. And you realize that most of the industry sectors have quite significant concerns in regard to the volume of their revenues, and sometimes costs when it comes to weather risks or parametric risks. Again, what we can do with the alternative products is we create an index that is tailored to a client and their specific risks at the risk location, could be multiple locations, very flexible to design and very tailored, and often, again, comes with great benefits from stakeholders that make these solutions not as expensive as they might appear at the beginning. And again, we can structure these by setting the retention levels to the price that the client wants to pay. Some clients want to, have a parametric solution very out of the money, and they pay a fairly low rate online for the solution. And then other clients are, using this as a volatility management tool, and they buy it very at the money, expecting a payout every 2 or 3 years. And use it really as a volatility mitigation tool. So very flexible in that regard. Lastly, I promised I go back to the question that we heard before in regard to the capital market solutions. You have corporations, insurers, reinsurers, who all have aggregate, quite significant risks, whether it's a catastrophe risk or life risks or, other insurance related risks. And they have a desire for ART to transfer those risks and give basically access to investment vehicles, or ultimately investors. That could be hedge funds, institutional investors, could in the extreme case even be individual investors, that ART can transfer those over. So the solutions don't have to be just in insurance form. They can be in capital markets, in bond form, securities form. And often this is being even designed with an investor specifically in mind, that an investor would specify certain appetite that they have for risks, and then the risk would be sourced with the corporations, but it could also be the other way around, that corporations have certain risks, or insurers, reinsurers, that we aggregate and then push out into the capital markets and seek the investors. So very flexible and, fast growing market, the market of alternative capital. I think my time is up, so I'll hand it over. And if I have not answered or addressed something, that I'm sure, Matthew and Bart will be able to do that.
And if you can just answer the question of the value when the financial markets are lackluster.
The financial markets, are generally very efficient. So if companies come to us, for example, right now, in the commercial real estate market, a lot of companies are, concerned that maybe our large landlords that, of office buildings or retail space, can they get insurance against a tenant default or so? And generally, if the financial markets are, what you describe in the question here as lackluster, or, have, certain inefficiencies and problems, insurance markets can often step in and solve it. But ultimately, we have to mitigate the risk for ourselves. We are not, for example, in the example that I just mentioned, we're not able to provide a solution that is more cost efficient than the credit default swap market would provide on a public company tenant default risk. Those risks, we access the same ultimate risk market that the financial markets would provide. So I think the value that alternative solutions give are really the structuring elements, the actuarial experience, and the tailoring of the solution to the specific client problem. If it becomes more of a commoditized solution, I think the financial markets are usually more cost efficient. I hope that answered it.
Aston. Charles, can we go to the first polling question? So the question is, have you participated in alternative insurance solutions, whether it's through an insurance contract, a reinsurance behind the fronter, or even a capital market solution? So I think that the time of the votes is finished. So, and it's the results of the vote are quite in relation with the question that has been submitted by Carl. He says that we are and have been talking about ART solutions since already a number of years within the risk management and insurance industry, but we have seen very few of those come to reality. How come? So, and we see that if you look at the polling question, we have a few persons that have participated. Maybe what is important to what is important to know is that, as Carsten say, most of those solutions are time demanding. They have to be often of a certain size to get the appetite of the markets. And no, I didn't see the poll results. Let me check. Oh, so nobody voted, from what I see. So Carsten, can you address this the fact that yeah, anybody responded? So, Carsten, can you just explain why? I mean, a lot of those solutions are used by the insurers themselves and perhaps not pushed down too often to their clients.
Yes, I agree with the notion that the question sets that this is not a solution that works for everyone, and we have a lot of conversations with clients and with brokers about solutions as an alternative to traditional insurance, and we go through the analysis. And sometimes clients decide that the alternative solution is the way to go. We like risk managers. We often sort of, maybe half jokingly say that like to be promoted, because if they have an ambition to try something new and be creative, the alternative solution has more chance of getting done. If the risk manager is more somebody who feels more experienced in the traditional realm, they might still ultimately decide to execute the traditional insurance solution. But we are doing a fairly large number of deals. When we talk to the brokers, you mentioned that, Stefan, at the beginning of your introduction. The current market and the dislocated nature that we see right now, with insurance companies pulling back capacity, there is just no alternative. I give you an example of a sector like trucking, for example. If trucking companies want to get liability insurance, they pay 200% in certain cases more than they've paid last year for liability insurance. And a lot of their risk managers are coming to us and say, we cannot afford that anymore. Is there anything else that we can do? And so we work with our liability colleagues to try to provide an alternative solution that makes this insurance affordable. And as I mentioned before, maybe not have all of the risk, with the insurance company, but have the client have retain some more risk or be more aligned with us through certain structural features. And some clients are just frankly willing to go through the exercise and try something new, but a lot of clients might not be. And those are not the ones that will ultimately buy the alternative solution. So the solutions can create a lot of value if the client is willing to go through the exercise and analyze it.
Carsten, I think we can go now to Matthew's presentation about captives. I think that there are a lot of ideas about captives at the moment. Matthew, the floor is yours.
Thank you, Stefan. Hello, everybody. Very pleased to be speaking about this really important subject today. I think with the market we find ourselves in, there's a lot of need for looking at alternative risk financing solutions, and captives is definitely one of the key ones of those, and that's what I'm going to be talking to you about today. So, to start off, I just thought it'd be worth sort of reflecting again on what some of the main uses and main advantages of setting up a captive are. So firstly, I've put down here an efficient tool for retaining risk. So rather than use a captive, you could just retain risk on your own balance sheet if it's not a compulsory class of insurance. The challenge with that, though, is setting up adequate reserves for long tail liabilities and also having the ability to retain profits so that you can take more risk in future years. A captive allows you to do that. The next one, I think, is probably the key one we see with most of our clients, which tend to be large multinationals. And that is that they have operations in many territories, but not all of them can take the level of risk that they can as a parent. So if you assess that you can take, say, the first 1 million euros on any property loss, it may not be that level of retention. You cannot push that down to each insurance subsidiary. So through your global program, you can have a suitable local retention, which could be, say, 25,000 euros or 50,000 euros. And then via your insurer, you can reinsure the first 1 million back into your captive. And thereby you take the level of risk that you can retain financially, but you don't push that onto an operating company who may not have the ability to take that level of risk. Risk management culture is key as well. So you need to make sure that everyone in the company understands that you're retaining a part of your risk. That gives a focus for identifying, mitigating, and managing risks. If you manage those risks well, then this is linked to one of the points lower down, in that your captive allows you to retain the good loss experience that you have through having a good risk management culture. Similarly, though, you need to accept that if you are taking a significant amount of risk through your captive, there may be years when you have bad losses and you're not transferring as much of that, and you're going to retain more of that. So you need to be really comfortable with how much risk you're retaining and the structure that you put in place in terms of limits and aggregates. Captives are a great source of making sure that you capture all of the relevant data, loss data. This can be great in understanding what the loss trends are, looking at the various components of your loss costs, and seeing if you can try and eliminate those. So it's a real good tool for sort of risk management. This one's very relevant at the moment, stability to pricing and budgeting. So if you're taking a working layer of losses within your captive, then obviously that takes out a proportion of the premium that would be going to the commercial insurance market. And in your captive, you will be pricing solely based on the loss experience that you've had yourself, not on other factors like, whether there's catastrophe losses in other parts of the world or whether the financial markets are not performing, which may come into account when an insurance company is pricing their structures. So you can also, in a market like we've got at the moment, a harder market, you can look at increasing your retentions to take an even larger percentage of the premium, keeping it within house and not having it in the commercial market where it is subject to sort of like increases and decreases over time. And then finally, captives can be used for risk where there is no traditional insurance solution or it's not economic to transfer the risk to the market. So we've seen examples of captives we work with who are underwriting non-damage business interruption, supply chain risks, intellectual property, and things like that. And I recently noted that in the Firma 2020 Risk Manager Survey, 43% of risk managers said they would use an existing or a new captive for risks which are difficult to place in the insurance market. So, this bears out what we're seeing in our own experience. Okay, just wanted to talk about the different types of ways you can use your captive. So the main two types is you can use it as a direct writing captive. So, for example, if you have your captive set up in somewhere like Dublin or Malta, you may be able to write direct into other EU territories and also into countries where non-admitted is permitted. Many European captives are based in Luxembourg, but generally these are reinsurance captives. So you wouldn't be able to write direct with those. You'd need a fronting insurer. There are captives which have a mixture. We've worked with captives where they write direct where they can, and where they can't in territories outside of the EU, then they use a fronting insurer. I would say most generally are set up as a reinsurance company and use a fronting insurer because the fronting insurer has the infrastructure and is able to pay sort of like the taxes and issue good local standard policies. The fronting insurer will usually be the lead insurer that you have on your program, and that will usually provide the largest amount of capacity, and also issue the policies and do the claims handling. So in this structure here, you can see that the parent company is the company that's engaged the insurer. They're paying the premium. the premium. The insurer will pay claims as and when they come through. The insurer will then reinsure a portion of that risk to the captive. The captive may be asked to provide some form of security or collateral. We'll talk a bit about that later, to protect the risk, because they probably are not as financially secure as traditional insurance companies. That captive may decide to purchase its own reinsurance as well. And it has a relationship with the parent company in the sense that it will be wholly owned by the parent, and it will provide dividends back to the parent, and it will retain profits as well within the captive. Some captives choose to invest by loaning back their sort of excess assets back to the parent company in return for a sort of a coupon, and so that there's that relationship back with the parent as well there. So that's how I would say most captive arrangements are set up. And we'll now just talk about the two different sort of types of approaches you can have to sort of how your captive is used. So we commonly refer to these as net and gross line programs, and I'm just going to explain what we mean by that. So on a net line program, the fronting insurer will issue its policy, and then it will reinsure to the captive just the part of the risk that the captive wants to keep for its own books. If there are reinsurers or co-insurers on the program, then they will reinsure to those as well. But in some instances, the fronting insurer may keep all of the rest of the risk other than the part that they reinsure to the captive. So on a net line program, you see there's two blue arrows. You could have two different sessions, one to the captive, one to the rest of the market. On a gross line program, there's just one session to the captive. So the fronting insurer reinsures all of the risk that they've written to the captive. The captive decides how much they would like to retain, and then they will reinsure whatever they don't want to retain to reinsurers or co-reinsurers, and typically the fronting insurer will be one of those. So there's an extra leg to that transaction. There are implications to this, and we're going to run through some of these structural issues now. So first and foremost, certainly from our point of view as a fronting insurer, we have credit risk. So if I take an example, you can imagine the fronting insurer has issued a property program with a €100 million limit. The captive wants to take the first €5 million. So on a net line program, we would just reinsure to the captive €5 million and keep the rest of the share, or share it with commercial insurers and reinsurers. Our credit risk to the captive would be €5 million per loss. But on a gross line structure, if we take the same example, our credit risk would be €100 million to the captive. The captive would still be retaining just the €5 million, but they would be buying the reinsurance themselves for the €95 million excess of €5 million. So this means our credit risk to the captive is €100 million, and that has implications to an insurer, especially under something like Solvency II regulations, as to how much capital we have to hold against that credit risk. The credit risk can be managed through legal clauses. It can be managed through collateral. And also you may find that the fronting insurer wants to charge a higher fronting fee to sort of reflect the higher capital charges that we now have on our balance sheet. So a gross line structure could result in more significant costs through the fronting fees, and it puts extra challenges on the fronting insurer from a credit risk and collateral point of view. In terms of the actual sort of capital implications for the captive themselves, on a net line structure, they had no reinsurance, so therefore they had no credit risk, and therefore they didn't have to hold any capital against that credit risk. They now have a credit risk because they have a reinsurance structure supporting them. And even though those reinsurers will be well-rated reinsurers, there will have to be some sort of small capital charge that they would have to keep against that credit risk. So it may be less efficient for the captive. You've also got operational risks associated with that type of structure. So there's more transfer of premium and claims between three different parties now, rather than just between the fronting insurer and the captive. So there could be more delays. There's scope for things going wrong, and there's more administrative time involved. So why would you want a gross line structure, you may ask? Well, from a captive's point of view, it does give you access to additional reinsurance players. So not everybody is set up to provide fronting insurer services, and there's many reinsurers who can provide capacity, and the captive can access that capacity through a structure like this. They can also generate some ceding commissions. So when they pass on the reinsurance, they take a percentage as a fee, effectively, and that goes straight to the sort of the bottom line of the captive and helps pay for the running costs of the captive. It also means that all data and all claims flow through the captive, not just the claims in their net retention. So that gives them complete access to all data and control over that data. So you can see there's some considerations there, depending on which structure they want to go for. Sorry, just need a drink. Okay, so now I'm going to talk about captives in 2020 and what we're seeing. So it's no surprise to hear that there have been an increase in captive formations in the last 12 months. We think this has been driven by the harder market that we now find ourselves in. I haven't got overall numbers because it's very hard to get that, but I did hear an interview with the head of Marsh Captives the other day where she said that they had added 70 new captives that Marsh managed in the last 6 months, and that was significantly up on the same period in 2019. I think there will actually be bigger increases in 2021 because there is a sort of like a time lag in getting these done, as we're going to hear from Bart later. You have to go to your board or C-suite to get approval to set up a new captive, so it doesn't usually happen overnight. So I think there'll be a lot of other companies looking at setting up a captive right now that haven't actually got to that stage yet. I think it touches on a question I think I saw asked as well was, at the moment, a lot of companies are cash constrained, so finding new capital to set up a vehicle like a captive could be a challenge as well. Not all companies have got that excess capital at the moment. So while it may make good sense to set up your captive to try and help tackle the harder market, it may not be a good time from the perspective of your board and getting access to that capital. We've also seen captives retaining more risk. So, most companies already have a captive, and those ones that have a captive, they've got that tool now, which they can use to help them in this current marketplace. So the type of new lines of business that I've seen particularly would be cyber, professional indemnity, and D&O. D&O is a bit of a surprise because it was always considered as a line of business that people wouldn't put into a captive, but you can certainly with side B and side C cover. And these are all classes of business which I would say are particularly hard hit at the moment in the commercial market, and therefore that's why clients are looking for alternative solutions. You could also put in uninsured risks or risks which are difficult to insure. And certainly the current health crisis and pandemic has highlighted to the C-suite that there are many uninsured risks. And a captive could certainly be used to try and formalize how you retain those risks. Employee benefits has been very fast growing. I think that's partly been driven by things like Solvency II, where there is a need to have economies of scale in your captive. So putting more risk into your captive and employee benefits certainly carries a lot of premium to it. It also helps sort of diversify the portfolio you have in your captive. So it's been a really big increase in that area, and that's continued in 2020. One thing I think you're going to see captives look at as they put more and more risk with different lines of business into their captive, they need to make sure they have protection so that they don't get exposed to having losses in every line. Unfortunately, in year, it's unlikely to happen. And by putting more lines of business in, you do create extra diversification. But if the worst case did happen across all lines, maybe they need to look at sort of having a stop loss structure, maybe along the lines that Carsten talked about earlier.
Matthew, just a quick question. You talked about employee benefits. So is it possible to find markets that are willing to give a stop loss which would combine, I would say, non-life risk and life risks on one end, and what lines do you see as difficult to put in a multi-line reinsurance contract for captive?
Okay, good question, Stefan. Yes, so not all insurance companies or through their reinsurance, I guess, of a captive, are able to put non-life and life together. It depends on their licensing. So certainly that's not something we can do. We could sort of put a reinsurance in place for the life aspects, of employee benefits, and then a separately for across all the other non-life side of things. I think there are some insurance companies that have sort of put in a sort of a legal framework which allows them to do that. In terms of sort of what lines I wouldn't put in a sort of a stop loss, I don't think there are any. I think the challenge is, if you're asking a commercial reinsurer to analyze those, is do you have any data around those unusual lines, and how is the program structured? Because if you want to put in something which is not traditionally insured and it could blow the full limits of the program, then that would be a challenge. So I think for those unusual risks, you would certainly want to see them sublimited. And you'd need to see sort of sufficient data for you to be able to sort of assess the impact it would likely have on that overall reinsurance structure. But I think it comes down to sort of like structuring and understanding the risk.
Gotcha.
The next, I was just going to talk very briefly, and I'm conscious of time, about protected cell companies. So these are what I would call the most recent sort of version of a renter captive, and in some other parts of the world they're called segregated account companies, or SACs. PCCs are owned by a third party. Typically it would be a captive manager or a broker, and then they rent a cell to a company who wishes to sort of retain that risk and use that cell. The core capital is sort of provided by the third party, and each cell is bankruptly remote from the other cells. If you would like to use a cell, you have to pay a sort of a rental or an access fee, and you will need to make sure you can satisfy the owner about how you are going to sort of pay for any losses that happen in that cell. Pardon me. So those cells are usually capitalized through the premiums that are paid. And then you may have to provide some other form of security for the risk gap between the premium and the full limits that are being provided, so that the owner of the PCC knows that their core capital is not going to have to be called upon, and you have sufficient resources in which to pay those losses. What are the benefits of this? Well, you don't have you don't have to put upfront capital into the structure. You'd have to capitalize your own captive. You do have cheaper running costs typically. They are quicker to establish because the PCC is already up and running, and it doesn't take so long to set up a cell. Similarly, if you were going to close it down, it's easier than exiting a fully owned captive. One other advantage that I've seen some companies use is if they have very decentralized structure, they could set up a different cell for each of their operating companies so that they could keep the risks segregated from the other operating companies that they have, and they can sort of see the financial performance within each cell. What are the challenges? As I said, you need to sort of like secure the full risk limit to satisfy the parent of the PCC. And you don't have any sort of overall control over the strategy of the PCC. Maybe the PCC owner might decide that they want to close it down for whatever reason, and then you wouldn't be able to sort of renew the risk within the cell. So if you want full control, obviously a full captive is better, but there are some advantages of a PCC, and right now some of those may be attractive to parent companies. PCCs are also used to set up special purpose vehicles, which are used for sort of capital markets type transactions. So for cat bonds and insurance linked securities, ILS, or pension transactions, they can be used to sort of convert a risk into insurance. So we do see them being set up for that, but most of the time we'd work with them would be a sort of a traditional use for a line of business within a cell where they just hadn't set up a full blown captive. Right. I could spend the whole time talking about this, although I'm not sure I'd be the expert on any of these subjects, but there is a lot of regulatory and governance considerations for captives right now, and I'm just going to quickly flow through all of these. So Solvency II is probably well known to everybody on this call. They've been dealing with it now for 5 years. It was first implemented in 1st of January 2016. So Solvency II had the impact of sort of increasing capital requirements for insurers and captives alike. It imposed on captives an increased level of governance, compliance, and reporting. It also impacted how fronting insurers trade with captives. As I said earlier, it sort of brought a heightened focus to how capital was allocated, and particularly the credit risk associated with reinsuring to captives, and then how fronting insurers managed that through collateral and fronting fees. It also sort of drove captives to sort of try and increase scale and efficiencies to sort of offset some of these extra governance costs. So if you've got to go through the process of sort of setting up a risk management framework and employing additional people to support your captive, then it's better to have more premium and more lines of business flowing into that. So that was helped drive the sort of the increase in employee benefits. Currently, the concept of proportionality is under review. The idea with proportionality is that captives maybe should be subject to some form of lighter rules than commercial insurers. I don't think it really seems to have taken effect, and by and large, captive is treated the same as any other commercial insurer. And I think, given that they are just insuring the risks of their parents and not third parties, it certainly would be beneficial if there was some sort of proportional measures for managing captives and a more simplified approach. And I know FIRMA are supporting that. Base erosion and profit shifting, or BEPS. This has sort of been in place again for a few years now. These are rules brought in by the OECD, the Organization for Economic Cooperation and Development, and the purpose was to ensure that companies were not transferring business between low tax and high tax jurisdiction country, or from high tax to low tax jurisdiction territories, in order to reduce their tax. And captives came under this and came to their attention because it's possible that premiums are paid in a higher tax jurisdiction, and then some of that risk and premium is passed to a captive, which is a subsidiary of the same parent, and it's in a lower tax jurisdiction. So what was important as we went through BEPS was to make sure that captives were evidencing why their captive was set up in that jurisdiction. So this was referred to as substance. Also important to sort of show why, where decisions were being made, and that they had the right resources within that captive location to make those decisions. A lot of captives are set up in locations because of the resources that are there to support them. Most captives have an outsourcing servicing model, and that's where the captive management operations are set up, and that's where they have local regulations which are sort of suited for captives, and they are in some offshore locations, but then they're also in EU locations as well. So the OECD are also sort of, this is something which is work in progress. It's often referred to as BEPS 2.0. Because there was still some dissatisfaction among governments around how BEPS was, implemented, and particularly with, the digital economy, so they're continuing to look at how they manage this. It's not only about the digital economy; it applies to a sort of all sectors, though. And Pillar 1 of this looks at how multinationals would be subject to tax in the countries where they operate. So even if they don't have a physical presence there, that's sort of the reference to digital economy, because you could be earning revenue in places where you don't have a physical location these days, and we need, and the OECD wanted to capture that. And then they're also looking at, should there be a global minimum tax rate? As I said, all of that is still under review. A lot of this is being delayed a little bit by the current COVID situation as well. And then finally, DAC 6. So this is so called because it's the sixth version of an EU directive on administrative cooperation, which aims to provide member state tax authorities with additional information to assist them with more rapidly closing sort of loopholes in tax legislation and harmful tax practices. It requires intermediaries who are working with companies to report on cross-border transactions where there is deemed to be some tax motivation to that. So intermediaries, that could be captive managers, insurers, or brokers. And, companies like myself are looking at which transactions we may need to report, if any, and what basis that's on. So This is again has been delayed now. The reporting doesn't actually have to happen until I think 2021. That may change again. It's changed a few times already, but it will be retrospective and we'll look back to sort of transactions since a date in 2018. So I think with all of these sort of key regulations, I think that the important thing is to make sure that arm's length nature of pricing is done between parents and captives. It's well documented and benchmarked. Adjustments are made if necessary. And I think you also need to make sure, you're regularly reviewing the capital structure of the captive. I think what some tax authorities are looking for is what they call cash boxes, where they see that a captive has way more capital than it really needs to write its risks. And that is in a low tax jurisdiction. So I think there's lots of things you can do to make sure that you can continue with your captive strategy without being impacted by these changes. And there's lots of advisors out there who can help people on that. But it's just worth noting how much there is going on at the moment. And that's without mentioning, as I know you wanted me to, Stefan, IFRS 17, which is due to replace IFRS 4. These are accounting guidelines in, I think it's 1st of January 2023. The aim of IFRS 17, can't say that, is to standardize insurance accounting globally where IFRS is used, which is not in every jurisdiction, but it is certainly in Europe, to improve comparability and sort of transparency on accounts. So it changes how assets and liabilities are measured. For example, it brings in discounting for long tail liabilities and also including risk margin adjustments. I would expect it to impact captives who are subject to IFRS accounting, but it will have more impact on anyone who's writing long tail liabilities than short tail, where discounting and risk margin adjustments are not so relevant. But there you go. I mentioned it for you, Stefan. That's the end of my presentation.
Matthew, I have another question because while you were talking about all these regulations and three of them are related to tax and arm's length considerations, how do you think the captives do this with what you have said earlier about the uninsurable risks, which are really difficult to rate and give quantification? Do the fronting insurers help in this case, even if they are not willing to insure?
Yeah, certainly. I think front insurers will have access to larger data. I mean, if it's truly a risk that very few people understand, more of a business risk, then I think you're going to have to make up assumptions using whatever experts are available to you, and then clearly document those assumptions. And probably, I would imagine they need to work with their accounting advisors and their auditors to make sure that those assumptions are understood and accepted. And therefore, if they're challenged, they have the rationale that they can show, which shows that they're doing this on as best a sort of commercial basis as they can, albeit accepting that there isn't a sort of an open market for this, which they can sort of benchmark against, like you would be able to for more traditional risks.
Matthew, I think now we are going to listen to Bart, who has been living the last few months with the idea of a creation of a captive. So I think for all the risk managers who have the same, who are on the same path, it's going to be very interesting. Bart, can you talk to us about?
Thank you, Stefan. Indeed, yes. So hi, I'm good afternoon. I'm head of risk and insurance at the Belgium-based company Umicore. And I would like to start the presentation with a short movie introducing the group and the industries that we are active in. So Umicore is a global materials and recycling company, and we have a global span. Now, I want to share with you the way we came to decide on setting up reinsurance captive, because it's reinsurance captive, with a netline program where we decided to insure some, let's call them traditional lines. So how do we come to that decision? Because as Matthew also mentioned, it's not an overnight decision that you take. It takes quite some time. Now, what have been our business drivers? I think it will come as no surprise to all of you that one of the business drivers is, of course, the hardening markets that we are currently seeing. This results in less capacity. It also results in wordings being revised, so less coverage, increased premiums, of course, and then more specifically for Umicore, we have also seen quite an increased number of deductibles. Unfortunately, we have suffered quite some losses over the past years. So that has caused the deductibles to increase. So the main reason today why we will be using the captive is for a deductible buyback or buy down program. Matthew also gave the example that where although the level of deductible might be supportable at corporate level, it might not be the case for the different entities throughout the world. And that's the situation we are currently facing. So that's one of the reasons why we decided to set up the reinsurance captive. It is, I mean, you need a long-term view, and you really need to use your captive as a risk management tool. So how did we tackle it? What's the timeline? And you will see at the bottom of the slide that when we will be up and running with the captive, which is scheduled to be the 1st of January next year, from the start of the project until the operational phase of the captive, it will be more or less 2 years. And initially, it started with, of course, trying to sell your idea. You are doing internal discussions, you're having internal discussions with your colleagues within the team. You're trying to seek and find support for your project. So it's very important that you have a very good internal network. And by doing so, I think it's also important that when you try to convince people of your project, that you also have a good background, that you can explain to them exactly what the captive is all about, what the pros and the cons are. So that's really helpful in convincing the people that need to take the decision. The next step in the whole process was to work together with brokers and consultants, first of all in doing a risk tolerance exercise, where we decided how much at group level it would be possible for us to take in the event of a loss. The next step then was to conduct a full feasibility study where we were using the historical losses of our group. We made a lot of assumptions. Unfortunately, we don't have a crystal ball, but the actuarial calculations help a lot, of course. And you also need to take a decision on your domicile. To make that decision, we used a specific questionnaire, and based on the answers given in that questionnaire, a few domiciles were then finally selected, out of which one was withheld as the final one. Once we finished the feasibility study, we did an internal presentation, first of all, to a smaller group of people, and then next was to do a full presentation to the top management, the senior management, the management board. And after that presentation, we got the first, I would say, the first green light to continue with the setup of the captive. Before really entering into that setup and the whole setup process, which takes a few months, we also organized several workshops together with one of the Big Four consultants. These workshops ran over a few days, and the topics in these workshops were specifically focusing on the setup process, the regulatory items, substance requirements, the structuring of the captive, and the participants to these workshops included also people from our legal department, the CFO, from our tax department. We were also discussing the composition of the board, of the different committees, and so on. Once we had finalized those workshops, once we had updated our concept, our project, we then presented a very detailed projection and 5-year business plan back to the management board, where then the final decision was taken to go ahead with the setup of the reinsurance captive. Now, the stakeholders involved in the whole process, and there are quite a lot of them. First of all, we have, of course, the different legal entities throughout the world, because they will benefit from lower deductibles in the first instance. Other stakeholders, of course, include the insurance world, and we have the brokers with whom we work together for placement of the risks, for discussions with the insurance market. With the insurance, the reinsurance markets, we have the consultants, captive managers that are involved. So the whole market, in fact, is working together on the setup of the captive. Then more internally, we had been working together with the finance department, tax department, treasury department, legal department. All of them were involved. More or less, but they were all involved in the discussions that we had. And of course, finally, the management board, because they have and had to take the final decision to go ahead with the captive. So it's quite of a journey. As I said, it takes approximately 2 years from start to finish, and there's still a few busy months to come, as we're currently really in the final setup process in obtaining our license. So my conclusions and takeaways from this project, from this itinerary, is that it's time consuming. It is indeed time consuming, but it's a very, very interesting exercise. In order for you to be able to convince your top management, you need to have a good business plan. You need to be able to describe and define your business drivers. So why do you really want to set up a captive? What's the pros? What's the cons? It's not a one-man show, far from that. You really need to involve the other departments, and you really need to have a good internal network. That, in combination with a clear communication and knowledge, clear communication also to your management board and to the senior management, will help you in getting the approval for the setup of a captive. And then the final takeaway or the final conclusion to me is that you really should be using it as a risk management tool and nothing else than that. So this brings me to the end of my presentation. I think we are also coming to the end of the presentations for this workshop. Stefan, I think the floor is again yours.
We have 2 polling questions now. Thank you, Bart. It was very interesting. Charles. So the first polling question is the following: do you think captives could form part of the solution for risks that are typically considered uninsurable? That's yeah. Since a lot of traditional risks get less and less insurable, that's a very good question. So So there were a few votes. So 2 are planning to use their captive more in the future for this type of risks, and 1 says that yes, the captive was in fact not strong enough to provide meaningful limits, and also there was no budget for those risks. Yeah, that's probably the case right now. Matthew, do you want to elaborate on this result?
Yeah, thank you. So thanks for those that voted. Yeah, I think there definitely is more of an interest to use your captive for these typically uninsurable risks. The challenge is, if they have not been pre-funded for before, that's a new cost that will have to be allocated out to the operating companies. And if it's a really significant risk, maybe like a systemic risk that goes through all companies, like the COVID-19 that we've just seen, how do you get your captive to provide a significant amount of limits, which makes a difference? So they are definitely challenges that are faced. But for those companies who do want to start trying to use their captive, then what I would suggest is, partnering with an insurer who may have some level of sort of appetite to take the risk. It may be that the risk is sort of more on a excess basis, or it's very very much limited. And if you start putting that risk into your captive, particularly if it's on a multi-year basis, you could sort of build up enough premium in that captive to sort of pay for a reasonably significant loss over a period of time. What you undoubtedly will do is you'll start getting better data around the risk, and I think that's a key when you formalize your risk retention. You often in the past you haven't captured that data around that risk, and therefore it becomes very hard to sort of understand the risk and to adequately price it, and also to manage the risk and stop things happening again. If you haven't sort of been notified when an event has happened, then you're not going to necessarily put in place processes to sort of manage it if it was to happen again in the future. So I think if you can make that step and partner with the right insurer who would like to support a captive as they sort of start to take some more risk around those uninsurable risk elements, then I think it's really good for the sort of the overall risk management of the company. But undoubtedly there are challenges in place.
So apologies, I'm being told that the poll function does not work properly. So sorry for the participants who tried to vote and did not recognize themselves in the results of the polling. Maybe thank you for all the presentations. Maybe we can have a few questions. A few questions from the audience, so you can type in your questions and we have a question which says, how can you make sure that the premiums which go to the captive can be less than the premium quoted by the market? Well, I think it's a difficult one with the transfer pricing. So maybe this one is for Matthew and maybe Bart also. Matthew first and then Bart.
Okay, I think when you look at the difference between a captive and a commercial insurer, a commercial insurer probably has greater sort of efficiencies and more diversification of risk across their portfolio. So the technical sort of price, they may be able to be more efficient in their pricing, but then on the other side, their costs are probably higher than the costs of a captive. So overall, what I tend to see is that captive pricing is very similar to commercial market pricing. In terms of the transfer pricing element, what the authorities are looking for is where the price that the captive is charging is higher than the commercial market. They're probably less worried where it's lower. I think maybe the insurer who's ceding that risk would be a bit concerned, though, if they think it's not commensurate with the risk, because it might affect their future viability. But I think on the transfer pricing, they're looking to see whether it's more significant than the commercial market. Generally, what you can do though is you can sort of like ask your fronting insurer to sort of price the layer that is going to the captive. And you could use that to sort of benchmark against what you think the right price is, because captives should be doing their own underwriting work, and obviously they have a different balance sheet from an insurer. So whatever the insurer's price is it's not necessarily the right answer for the captive, but they should be very similar, I would expect.
I think I would like to add to that. It's perhaps not necessary always to make sure that your premium that you're paying to the captive is always lower or much lower than what you would be paying to the direct insurer. It really depends on exactly what are you trying to achieve with your captive and with the intervention of the captive. Indeed, and as Matthew said during his presentation, when a traditional insurer, when a direct insurer is quoting a premium, there's a lot more information that they take into account when setting their premiums, which is something that within a captive, if you're quoting your risk for the captive only, you do not really need to take that into account, and that already can make a difference. That being said, you really need to make sure that you have good supportive documentation on why and how you did your calculations. And indeed, asking a fronting insurer or another co-insurer on your panel to make a calculation of what that layer would cost if you would be transferring it to the direct market is a good idea, I think, to have that benchmark.
I would also add that a captive has always a competitive advantage on the insurers, because they run at a lower administrative cost ratio. So yes, part of this saving can be transferred, but again, you have to be careful with the tax rules. If not, the saving remains in the captive. So it's still within the group. It's not pushed down always to the business units. But when the market hardens, having a captive also helps you to refrain the appetite of the insurers, especially if you can take the business from them in the captive. So they want to have more premium, but they still want to keep some business. So it's you can leverage your captive in the negotiations with your insurers. Bart, there's a question for you, and this question is well, there are two questions. One is, did you also consider using a protected cell company? And I think this answering to this question will also help to answer the question of Christo, who says who asked about the size of companies related, how big a company must be to start thinking about a captive. I think if you're not big enough, you can start with a PCC. But Bart, did you consider?
Well, yes and no. Of course, we considered the use of a PCC in the very beginning when we were looking at all kinds of alternatives, but very quickly we abandoned that road. Specifically for us, I mean, we decided to set up a fully owned captive because the premium level that we would be allocating to the captive was big enough to also cover these the working costs and other setup costs. Yes, we initially considered it, but we did not retain it as a viable option. However, I think that PCCs might be a good solution as a startup if indeed you do not have too much premium to allocate to your company, to your captive. Sorry. Now the question on how big or how much turnover does a company need to have in order for it to use a captive is perhaps not the right question to ask. I think there are companies having a low turnover that are using captives or other alternative risk transfer vehicles. There are companies with indeed very large turnovers, but I think it's more a question of what kind of risks do we want to transfer? A, B, do we have a suitable solution on the direct market or not? And C, what will the level of premium be that we will be transferring to the captive? I think those are more or better questions to ask rather than seeing how big or how large is your company based on the turnover.
Bart, maybe Matthew, an idea about how many, what is the capital minimum to open a reinsurance captive is about 3 million in Luxembourg, I think.
Yeah, I think what Bart said, I would agree with completely. It's around the sort of like the premium that you will be transferring to the captive, and the risk and how that is, what the options are outside of a captive in the external market, I think are key. You could have a relatively small company who's involved with, a business where the professional indemnity insurance costs are 10% of their overall turnover. So for them, it may make sense to have a captive, even though their turnover is not huge, especially if that professional indemnity is hard to get at the moment. So I think if you're looking at premium and how much premium need to go into the captive, I would have thought it needs to be a sort of a couple of million euros to make it worthwhile. When you think about the costs of running a captive, that would sort of be the minimum I would expect. But I don't think there is a hard rule around this.
Maybe because Carsten has not answered the question for a long time, so I'm going to put this question to him about cash flow volatility coverage. So I think you talked a little bit about it with the weather derivatives and so on. Can you give an answer to this cash flow volatility coverage?
Happy to do so. I saw that question there. Thank you for that. We're not tax advisors or accountants, and clients are well advised to seek their own opinion in that regard. But absolutely, the idea of the cash flow management is to manage the pre-tax cash flows. As I mentioned, that there's positive financing impact. We're talking to clients who are motivated to optimize revenues and expenses, and that generally is a view that is held way before you consider taxes. The taxes are, if you even decide whether you do something on an insurance basis or a financial product or derivative basis, I touched on that too. There's obviously a tax element involved there, because if you do something in insurance form, there's insurance premium tax to pay. But then if you have a claim, the proceeds on the insurance payouts are generally tax-free. If you do something in a financial product form, you don't pay the upfront tax on the product itself. But if you have a payout, then that is generally income for the company that is taxed at the corporate tax rate. So again, if the company determines that they have losses and they don't really pay corporate taxes, then maybe that financial product is more attractive. So those tax elements come into play, and generally these volatility management tools are considered before taxes.
Carsten, I'm going to take the Law's question about using the profit made by the captive to finance some prevention action. Loss prevention program, TPA for handling the claims, CatNat modeling. Yes, of course. I mean, that's also the interest of a captive. As I said, the administrative costs are lower in the captive, and the captive can fund the loss prevention program because it's at its benefit as well, and they are hiring the third-party administrator or the loss adjusters, and they can also do some CatNat modeling for monitoring their exposure or when they discuss with their reinsurers. So that's really something that a captive can do. And perhaps a question for Bart again, which is about the exit strategy. I mean, was it part, Bart, of your discussions with your management about what happens if we don't want a captive anymore? Was it part of your business case to the top management?
Yes, we briefly discussed the exit strategy. So what happens when all of a sudden you decide not to use your captive anymore, make it silent, or really liquidate the captive, and what are the options? Of course, I think the part of the question is also if there is any experience. I cannot say that I have personally experience. Now, it will also depend on the domicile that your captive is based in. Certain domiciles are easier to liquidate a captive. In other domiciles, you will be taxed on reserves, fully taxed on reserves that you will have in the captive. I mean, I'm aware of one domicile that allows the selling of the captive, or at least the reserve. Not sure if there are other domiciles that also allow you to buy and sell existing reserves. But yes, we have touched upon the exit strategies.
I think we have reached the end of this program. Thank you to the moderators for the presentations. The technique, and I think that you can move on to the networking lounge where you can meet some of us and other persons. Thank you very much.
Thank you. Bye.
You. Thank you.